Hello and welcome to the latest Moneymakers Investment Trust podcast with me, Jonathan Davis. A reminder that for regulatory reasons, nothing you hear today, however stimulating and insightful, should be regarded as constituting individual investment advice or a specific stock recommendation. Them's the rules we have to work with. This week on the podcast, it's time for another of our regular chats with Andrew McHattie, the editor of the Investment Trusts newsletter, who joins me to talk about some of the more interesting headlines of the last couple of weeks. So, Andrew, the market's been sort of ticking over. The investment trust index is up around 1% over the last month, following that good second quarter. So mainly we're going to just stick to talking about specific headlines that have come up. And I thought we might start by talking about Third Point Offshore Investors, ticker TPOU, where not for the first time involving a trust involving a US hedge fund manager, there's been a little bit of discord and perhaps a little bit of conflict between shareholders over here and the manager over there. Perhaps you could kick us off by just telling us what's actually happened with this particular trust, which is quite a reasonable size, I think it's fair to say. It's a market cap of around $445 million, looking at my screen at the moment.
Yes, well, I can tell you what's been going on here. It's an interesting tale and a salutary one, I think, because this has been the great row of the summer so far, pushing investment companies onto the pages of the newspapers for the wrong reasons. So effectively here, there's been a corporate development at Third Point where Daniel Loeb, effectively the owner of Third Point, has decided to stop this being a hedge fund investment and switch it into being an operating reinsurance company. So the idea is that Third Point Investors is going to buy a company called Malibu Life Insurance and is going to convert in quite a radical way. So there was a shareholder vote on this. And Daniel Loeb owns 25% of the investment trust, which is a key factor here because he is obviously backing this deal. But the terms were not particularly generous for other investors. And so this is really a battle between Third Point investors and I think the independent investors who really wanted to be allowed a full exit. Because if you don't agree with this radical change in tack here for this company, then maybe you want to leave on decent terms. And the problem is that the trust is trading on a fairly chunky discount to its NAV, about 25%. So it's not a great idea to sell in the market. You really want to achieve full value. So there's a limited exit offer on the table, which is a total of $136 million. So maybe around a quarter of the trust. And you're not being allowed out at NAV either. Now, the headline deal is that you're getting out at a 4.8% discount, which doesn't sound that bad, but you're not getting all of that up front and you're not getting all of your money out. So it's not really that attractive. So a group of shareholders opposed this, led by AVI Global, and certainly made quite a fuss about voting against the deal. And ultimately, actually, they failed because the EGM was this week and it was voted through because Daniel Loeb and the concert party voted for the deal. So this has gone through against the wishes of quite a large group of minority shareholders. And I know that's a long answer, Jonathan, but just one final point about it. And this is actually key, which is that the listing rules changed last year. And that really opened the door for this to happen, because prior to the change in the listing rules, for a corporate action of this nature, the interested parties would not have been able to vote. So effectively, it would have needed a majority of the independent shareholders to vote it through. And in this case, it would have failed. So the change in the listing rules has allowed Daniel Loeb to force his wishes through against those of minority shareholders.
Yes, so that's not a particularly happy story for the shareholders in this trust, or at least the ones who aren't part of Daniel Loeb's group, or his concert party, as you put it. And of course, the reason why the listing rules were changed was all part of a series of measures to try and promote the UK stock market, right, which we felt was not getting enough listings and so on and so forth. So it's a kind of... that was a kind of quite a fashionable cause to embrace back then. But we're seeing that there are some adverse consequences of it. That would be a fair comment, I think.
I think that's right. Be careful what you wish for. And this was designed to make London a more attractive place to list. So effectively less red tape. And that's all very well. But if you're compromising the rights of minority shareholders in doing so, then that's not the outcome that was desired. And I do wonder whether this experience, this story that's unfolded, will be a bit damaging actually for the valuation of other investment trusts where there are large individual holdings, large family holdings. So there are trusts like Caledonia and Hansa and Canadian General and RIT Capital, which are trading on quite wide discounts, partly because there are these large shareholdings involved.
Yeah, who have a dominant position and now, in this case, are able to control it with a minority of the shares. The other wrinkle of this, or the structure of this trust, was that they do have this thing called the vote code, don't they? Which is an interesting innovation. I don't think that fits into any corporate governance manual best practice that I've heard about. And this is a group which controls about 40% of the votes, I think, which has voting powers but no economic rights. Is that right? So it's a kind of, well, what is it? It's hard to say what it is. Whose interests are they acting in? I guess this is the question. And why did they set up in the first place? I think there were some technical reasons why they set it up in the first place back in the day. But it's certainly anomalous. I don't think anybody else has got a similar structure, have they? There are voting and non-voting structures, but not quite the same as this one, I think. Hansa would be one I was thinking of.
This is a bit of a tangled web, to be honest. I've tried to delve into it, but it's really quite tricky to understand what's going on. And I suppose maybe that's part of the setup that Daniel Loeb rather likes, actually, that he understands what's going on and maybe other people don't. But I think it's perhaps a warning against investing in rather out of the way esoteric investment companies that you don't fully understand, because actually your rights can be trampled on. Another very good example of that is Tetragon Financial Group, which does look tremendously attractive at first glance because it's on a massive discount to NAV, just about the widest of all. But actually, as a minority shareholder, you don't have any voting rights. So you need to check these things before you invest. It's quite important, I think.
Yes. The other thing about this is it's a Guernsey listed vehicle, I think. And, well, I don't know the individuals. I did listen to the chairman, what he had to say, but he's a director of lots of trusts, I think, like a lot of Guernsey based professionals are. And I'm not talking about this particular individual, of course, because I don't know him or anything, but there's a sort of element of perhaps rent-a-director about the structure, which may be another reason why Dan Loeb liked it in the first place. And I think it's fair to say also that the history of hedge funds, particularly managed by American hedge fund people, has not been particularly happy for the UK investment trust sector. Would you agree with that? I mean, there was a whole saga about Gabelli's hedge fund a couple of years ago, which again, there was a lot of issues around corporate governance. So you're right, you've got to keep your wits about you and you've got to look quite carefully into these things. But I guess you'd say that asset value investors, though they are professional sort of activists, they would have understood the structure perfectly. And they got involved in this one and they've had, I suppose you'd say, a bit of a counted as a failure alongside their other successes, which they've had quite a few recently. Well, probably come on to the one almost immediately. So let's move on from Dan Loeb. I think a lot of people will be not particularly unhappy to see him disappear from the investment trust universe. He's had his run-ins in the past. The other danger there, perhaps I might just mention, is that the investment trust basically gives you a passport into his main hedge fund in the US, but it's a very small part of his overall empire in terms of size, so it's never going to be a huge thing. Okay, so let's move on. Let's talk about another couple of trusts in which Asset Value Investors has participated or is a participant, and that is the proposed merger between two Japanese trusts, which has been announced recently. Can you perhaps fill us in on that one, first of all, what the details are?
Well, this was a power struggle that AVI did win. Yes, because back in May, actually, it proposed a takeover of Fidelity Japan Trust, FJV, which had been a serial underperformer in the peer group, actually, and I think was ripe for the picking. But it wasn't a done deal at all because there could have been competing proposals. But actually, now that deal has been confirmed, although with some amended terms, which is quite interesting. So Fidelity Japan Trust will disappear, yet another Japanese trust disappearing. So over the last few months now, we've reduced from 11 trusts to 7 in the sector. And this is going to merge into AVI Japan Opportunity Trust, which has a very good track record and does look like a very good home for the money. What is interesting is that when the proposal was initially made, there was a 25% cash exit on the table, but the Fidelity Japan board has managed to negotiate that upwards. So it's now a 50% cash exit opportunity at a 1% discount to NAV, which looks quite attractive, actually. If you look at the discounts that are ruling, the AVI Trust is currently on a 2.4% discount, Fidelity Japan on a 3.9% discount. There's probably not much in it, so you just need to decide whether you'd like to continue with your Japanese exposure. But I think taking the cash maybe is a reasonable option here. I'll always be interested to see actually just how many people decide to go through the exit door. These exit opportunities do generally seem to be taken up, which I think makes sense.
This is also interesting because we've talked a lot about SABA and we've talked a little bit about asset value investors, but the sort of key player here was actually another what we call discount player who we don't really hear much about. They operate mainly under the radar, and that would be City of London Investment Management, who basically I think had a very big shareholding in both of these trusts, 23% of Fidelity Japan values and 17% in AJOT. So they were basically the key voice in this one. But asset value investors being a fellow discount performer, what do you think about the trusts like City of London and 1607 and the other sort of big ones? You very rarely hear about them. If you ask most private investors in investment trusts, they would probably say we never heard of them. They've heard of City of London, the investment trust, which is quite a different vehicle, but not City of London Investment Management. Do you think they're a force for good?
Well, someone's got to own these investment trusts. And if you are an owner of an investment company, then of course you have rights just like anybody else. And if you're not happy with the performance and you feel that a change would be preferable, then fair enough. There's no reason why you shouldn't do that. And of course, I mean, you're right, City of London are a big player in this sector, particularly known for their emerging markets exposure. And they will sometimes hold quite a lot of power. I suppose what is slightly concerning if you're a minority investor, if you're a private investor, is that you don't really want deals to be happening in the background with low transparency. So I suppose if you have large holders who are effectively the power brokers and you don't really know about them and what their own motivations are, then that's not an attractive starting point, is it? But I think you've got to be realistic about it. And you're always going to have people who own large chunks of trusts who have their own motivations and their own desires to get out or to make a change. And if you're a minority holder, then you're not going to hold the reins of power, are you?
Indeed, you're not. And I guess at the same time, you could say, well, you're riding on the back of their efforts to some extent. So if they're making noises, they might have more impact than you would have if you were just a small individual shareholder. But it is an interesting point. 2 points about this deal. I guess on the Japanese sector, you say it's shrinking. And it's interesting that the board here went for a trust that has quite a different strategy. Fidelity have generally done pretty well with their investment trust. So it's a question, why has their approach not actually worked in Japan, where it's worked pretty well elsewhere? They're a very large international company, very research-led and so on. You would have thought that maybe they would do well in Japan as well. That's one issue. The second issue is interesting that the board went for AJOT, which is a different strategy, rather than another trust which maybe had a more conventional core holding in Japan issue. What do you think on the first point, though, about Fidelity? I mean, they have done very well with their UK trust, eventually with their China trust. I think you could say they've done well after a sticky start and so on. They're a very good fund management company, I think it's fair to say.
Yes, overall, I think they're a decent house. And it's a very interesting question to ask, actually. Why has this trust not succeeded? And I suppose the answer is that actually, for these large management houses, they do tend to have a house style. And that can work across a whole range of markets, but you can't necessarily expect it to work everywhere, and certainly not everywhere all of the time. And I suppose you have to bear in mind that I'm not sure when Fidelity Japan Trust was launched, but it's been around for a good length of time. And it's really failed, I think, in the last 5 years in particular. And so you could argue that actually it was just facing a style headwind and they would overcome that. But its underperformance was a bit too persistent here, and it wasn't that large a trust either. So I think in these feverish investment trust conditions where there's a lot of corporate activity going on, it did look as though it was vulnerable. Probably if you'd asked the same question 10 years ago when we were not in this environment, you'd have said, oh, well, it's having a rough patch, it'll probably be fine. But I think what this shows is actually the level of tolerance is now far, far lower for underperformance. So managers really have to be on their game the entire time. And it doesn't matter if you're backed with a big name, that's no protection.
I think that's a very good point, because if you look at the performance, if we go back 5 years, it was performing extremely well. I mean, extremely well after it shared in that sort of post-COVID rally of it affected everything. Its performance looked terrific at that stage, but it's only the last 5 years where its numbers look poor, and it has underperformed. Yeah, so I think you're right. And the fact about the size factor being probably critical in that sense. So if we look at the Japanese sector now, it's interesting. We've got two trusts that specialize in kind of activism. So we've got Nippon Active Value, which has done very well, and AJOT. What do you think about the other runners and riders in the Japanese sector? Do you have any favourites there? Do you own any of these ones?
I think it's really interesting that, as you pointed out, Jonathan, Fidelity Japan here has opted for a bit of a change in strategy when it's tying up with AJOT, with AVI, because it is an activist approach and it does stand out. Now, both AVI Japan Opportunity and Nippon Active Value stand out. They are the best performers of late, and their strategy has clearly been working very well. But I have read a couple of articles actually posing the question as to whether actually that strategy has run its course. Maybe, in fact, this early stage benefit that you get in Japanese companies releasing their large cash balances and generally catching up with the rest of the world in terms of modern corporate governance, maybe that period has run its course, in which case you're switching horses at the wrong time, aren't you? But that's always a risk. And I think that's quite hard to judge from the outside, actually. For the moment, those trusts do look set. My favourite for a while, and the one that I do own actually, is Schroeder Japan Trust, which is a much more mainstream, straightforward trust. I quite like it because it does invest across the asset spectrum. So I'm not having to make that difficult choice between large caps and small caps. And I think it has a reasonably consistent record, which is really what I was looking for when I was making a choice here. So I think if you want to follow the trends, then AVI Japan and Nippon Active Value definitely look like the places to be. But if you're a bit skeptical about that continuing and you just want something that's going to give you broader exposure, then I think the Schroeder Japan Trust is a decent place to be.
Looking at the sector also, I mean, there's a couple of very large beasts in there. We've got JP Morgan Japan, which has got a market cap of around 1 billion, and Baillie Gifford, which is perhaps the kind of sleeping giant of that sector, which has done very, very poorly recently because of style factors again. So if there is any kind of style rotation, that's a 690 million market cap for that one, both of which those two are bigger than the two we've been talking about, the discount players, if you like, corporate governance players. So it's a very interesting sector, but it has been shrinking, and Japan, well, it has been a relatively good place to be. But there's been a great divergence in style. So you're absolutely right. I think it's interesting what you say, and I hear what you say about the Schroeder Japan Trust, which has done better than nearly all the other ones, apart from the ones we've just been talking about, the corporate governance players. You are listening to a Moneymakers podcast. We are an independent research and publishing venture, and grateful to JP Morgan Asset Management for their generous no-strings financial support, which enables us to keep the podcast free and our editorial principles intact. Each podcast episode goes live shortly after being recorded, with a weekly catch-up email notification every Saturday afternoon. Why not also try our premium weekly subscription Moneymakers newsletter, which provides a comprehensive summary of all the latest news, results and performance data from the investment trust sector, with links to the relevant stock exchange announcements if you want to go down that rabbit hole, and many other regular features including more than 170 in-depth and independent trust profiles, regular market commentary and videos, plus the editor's list of favourite funds. If you never want to miss a thing that might affect your portfolio, do please sign up today at money-makers.co. And if you follow this podcast on YouTube, please do use the subscribe and like buttons. Thank you. So let's talk about another trust which has been wrestling with issues, and that is Bellevue Healthcare, ticker BBH. Now, this one's been in the news rather too often for its own liking, I think. And, well, are we entering a critical phase, perhaps a terminal phase for this particular trust? Tell us what the latest is on this one.
I think this is just a mess, this one. It's been a terrible performer of late. And again, I think it's a case of how much slack you want to cut the managers, because they've always been idiosyncratic. They've always run a concentrated portfolio. They've always been different from the index, from the mainstream. And recently that's been working against them actually quite severely. But this trust, I think, has structural issues that have really dogged it actually for quite a long time. So this trust for quite some time had an annual redemption policy once a year in the late autumn. And this was enthusiastically taken up over the last couple of years. And the board didn't like this very much because they were losing a big chunk of assets each time they did this. So they decided to have a think about a different structure. And then early this year, they decided that they would pursue a zero discount policy, which they instituted in April. And I think we talked about that at the time, Jonathan, and really thought it was going to be quite difficult to implement, because a zero discount policy is okay if you have a very conservative underlying asset base and it's not that volatile. But in the case of a concentrated healthcare trust, you're going to have ups and downs. There are going to be periods where it's risk on and risk off. And if it's a risk off period, then you have people selling, and you're going to have to try to maintain the zero discount by buying back heavily. And that's what the board has found, because actually when they instituted this zero discount policy, the trust had about £280 million worth of assets. Now it's down to 165 million. So it's spent over £110 million on buybacks. And this was clearly not something the board anticipated, because every month now they're having to request a shareholder meeting to renew the authority. So they bought back on this massive scale. It couldn't continue that way because the trust would disappear straight away. So effectively, this has been a failure of corporate governance. It's been a failure of the buyback policy. And it means now the trust has instituted a strategic review, effectively a beauty parade of managers. So it seems to me as though a change of manager is extremely likely here. That's going to happen in a couple of months' time, I would think.
Yeah, I can't disagree with what you say. To me, it also highlights this issue that an annual redemption policy is all very well, but it's a pretty blunt tool, and it doesn't really take account of the fact that, as we've mentioned already, there are style factors and there are different things that could certainly affect one-year performance. But then you might ask a question also about the shareholders who take it up. There's an element of, well, I'm taking it up because it's an opportunity I might over pitch into the offer in order to make sure I get my share. It's been a bit of a mess, as you say, and I think it's a cautionary tale, is it, for the reasons you say. And I think in a way I'll be ashamed to see it go, because we keep saying that investment trusts should be different, they should be differentiated, there should be something specific about them. But I guess 5 years of poor performance is a lot, and that is no longer acceptable in today's market conditions. So yeah, I suspect that'll be the end of that one. Do you think someone will take it on, or do you think the risk of actually losing even more market cap will mean it'll end up being uneconomic, essentially, for someone to take it on?
I do wonder about that. Because it's 165 million, I'm not sure that's big enough now to operate as a standalone trust, especially because, of course, some of those investors will probably want to come out, because whatever you're offering, it's not going to be exactly the same. So you've got to offer some kind of exit, I suspect. So a merger seems more likely. So it could well be that one of the other biotech and healthcare trusts will decide to take on these assets.
Well, let's talk about a more cheerful subject. We talked about trusts which have suffered poor performance, and that's causing them problems. So let's talk about one where seems to be making a revival, and that one is Baillie Gifford US Growth Trust, ticker USA, which has come out with some results, very impressive results. This was one of the trusts that was in the spotlight because of Saba Capital taking a big stake in them earlier, and one of the 7 trusts that was basically where they requisitioned a meeting asking for change. Perhaps you just fill us in on their performance since then.
This is a great example of exactly what we've just been talking about, actually, how you can have a period of poor performance and then you decide to wind up or come out at exactly the wrong moment, and then everything's great again. Because actually, of course, investment is inherently cyclical, and often the best bargains to be found in the things that have just gone down. So I was very pleased actually to see this trust have a much, much better time of it. As you say, it was targeted by Saba late last year, managed to get through that. And it's announced its results now for the year to the 30th of May. And its NAV total return was 24.5%, which compares to the S&P 500 up 7.2% over the same period. So a massive outperformance, clearly driven by its heavy emphasis on growth stocks. So actually companies that you probably have heard of like SpaceX, Duolingo, Netflix, Cloudflare, and Spotify all help drive this portfolio forward. And those were a drag before, and now they've become a tailwind. So it's really good news actually for Baillie Gifford and for this trust. It is now the number one trust by NAV performance over the last year. It's on a reasonable discount of 8%. So it looks reasonably set fair going forward. Of course, things might look very different again in another year's time. Who's to say? But I do think this illustrates the fact that performance can be extremely lumpy. And if you're a long-term investor, perhaps you're prepared to ride out actually a fairly extended period of subpar performance because you want these really great periods in your portfolio. And here's a trust that has, trebled the return of the main index over the last year. And it's great to have it in existence so that it has the opportunity to fulfill this potential. Whether or not it'll carry on is an individual matter. You have to decide that for yourself. But I'm pleased it still exists.
I guess one has to give credit here. I mean, Saba will have made some money out of this one, which is not something they've done in every case where they've been involved. And as I recall, this is the one where they said one of the reasons they owned it was because they liked some of the underlying holdings, the things like SpaceX and so on, which they might have kept. It is true, I think, that obviously, like all the Baillie Gifford trusts, or most of them, it has a significant holding in unlisted, and they perform particularly well over this period, which is based on, obviously, manager valuations or semi-independent valuations. So I guess there's still a little bit of a query about that. But any kind of sign that we're getting IPOs of any of these large holdings that Baillie Gifford has across several trusts would be beneficial. So, I think it's a heartening story because I think there's been no real losers out of this one, I think it's fair to say, in the sense that the board, they have had a bit of a kick up the backside. The manager's been told to sharpen up, and they have made one or two changes to the way they manage the portfolio, I think. And Saba's made some money, and the rest of the shareholders have at least seen a positive return. So let's take that as a good news story. Let's talk next about Smithson, ticker SSON, a very interesting trust. It is a global smaller companies trust that is managed by Fundsmith, started by Terry Smith, well-known investor, whose main Fundsmith trust has been underperforming now for 5 years, but still very popular with many investors. But Smithson is an investment trust, and it's obviously performed not particularly well. Tell us what the latest news coming out of this particular one is, Andrew.
Smithson is a global smaller companies trust, and that's actually quite a small sector to begin with. So I think it's, again, good that it exists. It gives this opportunity for investors to participate in this sector. It's quite a big trust, hasn't done very well over the last 5 years. But again, perhaps there are good reasons to be patient here. It was slightly better in the first half of this year. So the trust released its interim results, and it showed a net asset value total return of 2.4%, which was ahead of its global benchmark. But 2.4%, though, isn't that great when you compare it to the broader investment universe. And clearly, smaller companies have been very much disadvantaged against large companies that have been driving the returns of late. So, in fact, over 5 years, if you look at the performance of Smithson against the broad investment trust sector, it looks pretty awful. It's ranked 199th out of 238, so very much near the bottom. But what is interesting here is that you might expect it to be on a wide discount as a result, and it isn't. The discount's about 9%, and that's down to the commitment to buybacks here. And I think this is the really key point about this. Actually, the board here has bought back a lot of shares. So in the first half of this year alone, they spent £235 million on buybacks. That's about 12% of the equity. And since the buyback commitment was introduced in April 2022, so just over 3 years, they bought back 35% of the shares, so more than a third of the trust. So clearly that's been very supportive. But I think it raises quite an interesting question here. I'd like to ask you this, actually, Jonathan, about buybacks distorting the market. So in this case, what's happened is that the discount looks okay. So the trust is not under any particular pressure. It's still of a good size. It's £1.8 billion. But maybe we're looking at the wrong indicators here, because a lot of trusts on wide discounts are winding up, but actually maybe we need to be more focused on the performance rather than the size of the discounts. They're not quite the same thing. We have seen some good trusts that happen to be on wide discounts come under pressure for corporate action. Equally, we've seen some trusts with slightly poor performance records that are not under pressure because their discount is okay.
Yeah, it's a sort of push me, pull me thing, this, isn't it? In the case of Smithson, I think my take on that would be when it launched, it was on the back when Terry Smith was performing really well. And the model, the basic model, the strategy of this trust is very similar to the Terry Smith formula for the Fundsmith Equity Fund. So it was on the back of that. And it raised an awful lot of money initially, and then in subsequent issues, they issued a lot of shares. It was kind of a momentum thing, I would say. And so they got very, very large very quickly. And now all that's happened effectively is that they've given a lot of that back again. But the performance has not particularly picked up yet so far. So I think my point on that would be they could afford to do it because it's such a large trust. They've made that commitment and they've kept it. So that's a good thing. That's a plus for the board. But having said that, if you're sitting on another board and you give you strength to those who say, well, buybacks don't work kind of thing, because they'll say, well, look, they bought back a third of the shares. They've seen the size of the trust shrink by a third. And yet the performance, they hadn't been rewarded by the discount coming in that much. It's still 10%. Okay, it's a bit better than it was. It's better than 15%, but it hasn't come in that much. So they'll be arguing that maybe isn't as buybacks don't work. I don't think that's correct reading myself, but I think your point is absolutely valid. I think you either like the formula that the Smithson has and that Terry Smith has, which is basically quality growth is what they're going for. It doesn't seem to work quite so well in the smaller cap area than it does in the large cap area. But if you look at the look-through numbers, they're all very good. So I would think this one actually will perform well again at some point. And I personally would give the board credit for basically giving back a lot of the money that they raised in a different period. And we'll see what happens. I guess if you are a shareholder, you'll be disappointed that the performance itself hasn't improved. It has made some changes to the portfolio, and I think that maybe will work out as well. But there's a new chairman, of course, taken over. Perhaps he's recommitted to the buyback. So interesting to see how that one plays out from here. Let's talk about renewables, shall we? This is more a kind of generic issue here. We've had some results from a number of renewable infrastructure trusts. We've had a few continuation votes as well, which have been passed. But there's also quite a lot of activity going on, mergers, wind-ups, and so on among the smaller companies. What's your overall take on what we've learned in the last couple of weeks or so from the results you've seen, Andrew?
There's been a lot to take in, actually, Jonathan. Yes. So I think there's been quite a lot of interest, actually, in the renewables infrastructure sector, partly, I think, triggered by the takeover of the Downing Renewables and Infrastructure Trust. I think perhaps there's been an anticipation of a lot of corporate action happening in this sector that didn't arrive. And then finally it did. And that helped discounts actually to narrow quite a bit. So they came in to 24%, having been probably 10 percentage points wider a few months ago. It helps as well that I think there's pressure on interest rates to come down. We've seen a cut in the bank rates, so that helps as well here to generate a bit more interest. But some things haven't been generating quite so well, and that's actually the point of the results period that we've been through. This unexpected factor has occurred. The UK was not very windy in the first half of the year. There are so many variables in this sector, lots of moving parts. You've got to think about subsidies, power prices, inflation, discount rates, and you've got to think about the weather. And this was rather unexpected, that the UK was not very windy. And this is a problem because actually for Greencoat UK Wind, it said that the power generation in the first half of the year came in 14% below its budget. So that's a long way below. We tend to think of wind actually as being a pretty stable resource. It's pretty much the same every year, but that wasn't the case this time around. And that's put pressure on some of the asset values in the sector. So I think usually when we're talking about discounts narrowing, we're talking about the share prices going up to narrow the discount. But of course, it happens in the other direction as well, which is the NAVs coming down. And there's been a bit of that going on. So across the sector, we've generally seen net asset values slipping a bit over this period. So in the case of Greencoat UK Wind, the NAV was down 5.2%. In the case of the Renewables Infrastructure Group, TRIG, which also has 3/4 wind in its portfolio, its NAV was down 6.6% over the half year. And that matters because actually that's reducing dividend cover. It's reducing the discount in the wrong way. So it's interesting timing, just as investors are getting interested in this sector again. So we're getting a bit of bad news. So it's a little bit uncomfortable at the moment. And we have seen some of these share prices fall back a bit as a result.
Yes, indeed. I'm among those who've been hoping that this would mark the turning point, basically, for the sector, which has had a torrid time over the last 3 years or so, with discounts widening from what were premiums in many cases. And yes, the performance this year in terms of NAV has been disappointing because it's not just the fact that generation has been down, but it's also the fact that in one or two cases they've reduced their power price forecasts as well, which of course is another of the issues around these trusts, which is because they're effectively what we call mark to model. They're based on a whole series of assumptions over long future periods. It doesn't take a lot to change that. And I think I looked at the TRIG results, for example, where only I think one of the three consultants they used to make the price forecasts changed his view quite significantly about future power price trends, and that really took a hit to the NAV as well. And that's always been my concern about the renewables, my anxiety, if you like, even though I've been hoping they'd turn the corner, is that just maybe these models are too optimistic, basically. Generation, I agree, the wind doesn't blow. That seems to be a random factor. You can't account for that particularly. Though we don't know, of course, climate change may have something to do with that, I suppose. But the power price forecasts are essentially crucial. If we get a recession, they'll get knocked and so on. And of course, the discount rates are also relevant. But a lot of people hold these things because they're still paying big yields, 8, 9, 10%. And you keep thinking, well, that's compensation, isn't it? At least they're paying me some money. But essentially, all you've had for the last 3 years is what you've gained on the dividend you've lost on the capital side. So, yeah, I think the jury's out. I mean, I keep watching them very closely, thinking this must be an opportunity. But it's been disappointment. But TRIG and UK Wind, the two you've mentioned, they're very large. They're not going to disappear. But it looks like being a longer haul than we'd hoped in many cases. The continuation votes have all been passed. Were you surprised by that? Apart from, obviously, one or two of the smaller ones have gone by their own action. Didn't have to wait for continuation votes, really.
I wasn't surprised at all, though, because actually I think very often when continuation votes arise, they tend to fail if there's a specific problem with a trust. And I don't think there are any problems with these trusts on the whole. They're large, they tend to be quite well run, quite well managed. I think there are a lot of sector-wide issues, including power prices, as you rightly say, Jonathan. That's a big one. And who knows what will happen if there is actually a resolution to the Ukraine-Russia war as well, what impact that might have. So there are always a lot of variables that are out of your hands as an investor. You can't really predict whether, as you say, one of the consultancies used to forecast power prices 10 years hence is going to change their mind about the likely path of those. Nevertheless, I do think actually that the yields are very supportive in this sector, and potentially there's a bit of good news to come. The discounts are still wide. We might see a bit more corporate activity. So I think if you're a holder, you can never be certain of the future path of these investments because there are these extraneous factors. But I think they're fundamentally quite solid, actually. And as an income investor, they probably do form a part of your portfolio. I think most of the dividends now are reliable. There's a lot of talk about this, with TRIG in particular, because it's saying that the dividend cover for its dividend this year is going to be very tight. But the very fact that it's talking about that in a transparent fashion, I think is very helpful. And it is saying that next year won't be so tight. So I think the sector's basically fine. And if you're an income investor, you can take these tremendously high yields and hope that your capital doesn't erode as a result.
I think it's fair to say that it is true that longer dated gilts and index-linked gilts in particular, which are often used for comparison, are still rising, unfortunately, because of our fiscal issues we have in this country. But that's not been a helpful factor either. Finally, then, let's just talk about Throg. This is BlackRock Throgmorton Trust, one of the many UK smaller company trusts that we have in the investment trust sector. You picked those out for mention, and perhaps you could explain why, Andrew.
I noticed something particular about the results here. Just a bit of background. The BlackRock has two UK smaller companies trusts. So it has BlackRock Throgmorton Trust and it has BlackRock Smaller Companies. And for years, actually, people have been posing the question as to why those two don't merge. They're both quite substantial. BlackRock smaller companies is 630 million, Throgmorton's 500 million. So they're fine as standalone trusts in their own right. But they could come together to form one great big behemoth in the sector, which might be quite good. But BlackRock has always said, no, these trusts are quite different, actually. And Throgmorton is a more complex trust. It can take short positions, it uses derivatives, and it has a different approach. And to my mind, that's not always been true. There's often been a lot of overlap. But I think right now, actually, Throgmorton is distinguishing itself and it is differentiated. And that's the interesting point. So we're very used to hearing from managers how their sector is looking great and the outlook is superb. And that's normal. You have to take that into account when you're listening to managers, don't you? So that unfettered positivity is normal. And it's especially normal if you're listening to a UK manager, because they'll talk about how cheap the UK is. It's even more normal if you're listening to a UK smaller companies manager, because they will tell you that there's another layer of value on top there. So it stood out to me when Dan Whitestone, the manager of Throgmorton, actually said, yeah, actually, we don't really like UK smaller company cyclicals at the moment. That stood out because it's unusual. He pointed out the precarious nature of the UK's public finances, some weaker macroeconomic data coming through, some softer company statements. And so actually he's been reducing the long exposure to UK cyclicals, including house builders. And he said he's still finding more opportunities elsewhere. But what is interesting is that he's been buying some more overseas exposure, so shifting money out of the UK here. And he's moved that up to 12%. The trust has a limit of 15. So that's quite unusual. And that's what really caught my eye here.
Yes, that's a very interesting point you make there. The other point I make about these two trusts is they both trade on a discount 11, 12%, something like that, I think, which is in the period we're in when discounts are very much in vogue. I just wonder whether now seems to be generally held that if you're an equity trust, one of the large equity trusts, you need to have a single digit discount. Otherwise, people are going to start jumping up and down and make you do things. I wonder whether that's also going to become true for some of these smaller companies trusts, which have been trading on more than 10% discounts, many of them for a long time. But do you think that's a factor for these two BlackRock trusts? They've both got discounts of wider than 10%. If they are very different, would that be a concern? You would expect one to be perhaps better than the other?
I wonder whether BlackRock can just keep this in their back pocket, actually, for a rainy day. So at the present time, I don't feel that those discounts are standing out. Of course, we are used to smaller company trusts trading on wider discounts. That's always been the case. There's been an illiquidity discount there because actually, if you wind this trust up, you can't necessarily sell all of your holdings at the market price straight away because you're too big. So you're going to have to sell those things at a discount. So I think those discounts that are just into the double digits are probably just fine. But if we do enter a more difficult period now for markets, and I think we are entering that danger zone of September, October, where markets can often be volatile. If we do go through a bad period and those discounts widen out to maybe 15 to 20%, then at that point, if shareholders say to the managers, look, we're not very happy about this, or they say to the boards, we're not happy about this, then they could always explore that option to merge at that point. But I don't think there's any immediacy required.
Just making a point, because some of the smaller company trusts are now trading on narrower discounts. So Henderson Smaller Companies on 8, JP Morgan, we know, is on about 8.5, Mercantile is on about 10, I suppose. And then there's the Odysseans of this world who are interestingly on a narrow discount because of their buyback policy, but actually not performing well. So it's an interesting spectrum. That's the point I'm making, I think. The fact that Saba was involved and BlackRock had a standstill arrangement with Saba, is that a factor, do you think? Maybe the discount would have been narrow if they had been on the Saba list. Who knows? I guess that's a factor to consider as well.
Well, it could be. Again, there's quite a lot of information here that we're not privy to. And so you never know actually what might have happened to these trusts and their discounts if Saba had had a free hand. But maybe I'm being a bit old school here and it speaks to my sort of long time in the sector. But to me, actually, 11% is not a wide discount for a UK smaller company trust at all. And I fully appreciate we're in this different environment now, Jonathan. So you're right that we have to shift our boundaries here, don't we? But it looks fine to me.
Yeah, and it's fair to say that the small companies generally, they do trade at a discount, or have done, apart from periods when they're in vogue, which are ones we talked about before. Well, I have to call it a line there. Thank you so much, Andrew, for your time and thoughts this week. There were a couple of other trusts we didn't have time to talk about. Interesting developments at River UK Microcap, talking about small caps and how boards are reacting to issues, including the potential risk coming from activists, and Utilico Emerging Markets. We were going to talk about those, but unfortunately we run out of time this week, but those two are worth looking at if you're following us closely. So thank you, Andrew, and we'll look forward to further discussion in due course.
Thank you for listening. The Moneymakers Investment Trust podcast is independently produced and edited and is freely available on YouTube, Apple Podcasts, Spotify, and other podcast channels. You can also sign up at money-makers.co to be notified of each new edition. If you want more news, analysis, interviews, and other investment trust content, don't forget to look at the Moneymakers Circle, available for a modest subscription at the website.